Welcome to the Real Estate Investing Club. This is the place everyday real estate investors gather to share their best stories, biggest insights, and favorite tactics to grow a portfolio of cash flowing properties in today's market. Here's your host, Gabe Peterson.
All right. Happy Friday or Monday or Wednesday or whenever you guys are listening to this. This is another episode of the Real Estate Investing Club. And today we have Josh Shein with us from Trias Lending. Josh is an expert on the lending side, which is a very, very touchy subject in today's market with the high interest rates. He is also a flipper and he does multifamily. So a lot of experience here to jump into. Josh, I am super excited to jump into this. Thank you very much for hopping on the show.
Really glad to be here, and thanks for having me.
Absolutely. I told you before we hopped on here, we like stories. We like to start here how you got to where you are. So why don't you take us back to the beginning? How'd you get started in real estate?
The short story, hopefully I'll be short with it. It's family. That's the first thing, right? So my grandfather, my uncle, my dad, real estate investing. I'm originally from Providence, Rhode Island. So a New England native, and real estate goes back in the family as long as I can remember. Growing up with my dad, going to pick up some rent checks, and I'd be in the car on a Sunday when he had to, knock on some doors, right? Old school. So I always grew up around it, always loved it, was always really interested in it. Fast forward, I was in a business with my dad, and we ended up selling that business, a medical company, and we ended up sort of each going some different directions. He went into some other finance, and I got into mortgages. And I got into traditional mortgages, traditional lending, residential refis, purchases, et cetera. Fast forward after 14, 15, 16 years, very successful on a national level and some large companies in that world. I really was getting a little tired of the regulatory environment and not having that relationship side of really being able to build with people and connect with people on an ongoing basis. And I reconnected with someone who I had known, who's now my partner, Steve Bond, him and his son, David. And we all got together, and he had been doing hard money lending. And I said, I'd love to really scale this up and be a part of growing this thing. And we could really establish relationships differently, work a little more locally. I wouldn't have to travel as much. That all really appealed to me, and not as much paperwork and licensing either, which was nice. So long story short, we got together, and we've grown really exponentially over the past few years. Been about 6 years now, and now we've got 63 million in loans out in the local marketplace. We've raised everything from friends and family. We don't have sort of institutions behind us, and it's been just incredibly successful. We're having a great time, and we love building those relationships, long-term relationships with all of our clients.
Nice, man. I love it. And I've said this for other people who've come on the show who grew up in a real estate family. I am so jealous of having that background, being able to see it. If you had your dad taking you door knocking,
Right.
Getting rent checks, stuff like that, that really does give you a solid foundation to kind of leapfrog from. So it sounds like you had a good background, and then you got into lending on the mortgage side. So what I'm just trying to figure out where there's a lot of things to go into when you're talking about lending.
Yeah.
And you guys are on the hard money side. Let's first, before we get into anything else, let's talk about the market today. We are in an environment where, it's March 2023, almost April. Interest rates are not where they used to be. I know they're not as high as they have been in the past. My dad was saying, back in the day, interest rates were 10%. But they are, they're higher than they were a couple of years ago at 3%. It was just a great time to be getting loans. But in today's market, where do you see the interest rates heading? Do you, we're at 7% right now. Do you see this as being the top? And if not, where do you see it going in the next, 1 to 2 years?
Right. No, great question. It's something we talk about, and it's obviously something we all try to figure out. And the first thing I would say is I'd preface any answer by saying no one can know for sure, right? Yeah. We're all just pontificating and sort of giving our best educated guess based on our years, based on our history. Having said that as well, history is always a guide, but there's always exceptions, right? With anything, whether it's stock market investing, real estate, et cetera. This has been a phenomenal run up we all ran into. And then COVID had its own sprinkled its own issues into it, right? Some good, some bad,
it's
right?
Flavor,
and then we come out of it, and then different issues with the economy, and different issues with inflation and wars, and all those things factor in. Having said all that, we knew rates were going to go up, right? So let me just start with that. We knew it was not sustainable to be looking at long-term rates in the 3s and 4s. That was never going to be sustainable. Now, whether our dads and our elders talk about the 15 and 16% in 1984, okay, I don't know if that was really normal either. If you look at those averages over history and you look at where you feel like the market should be and where the numbers seem to make the most sense on the investing side, Wall Street side, the bond side, and then for us as real estate investors, my gut, and we sort of feel this way at Trias Lending, that like the 6-ish, 7-ish range feels like the right place for things to end up. So if we're in the 7s now, and there's some products and programs that are into the 8s, I don't think that's necessarily crazy. And I think there's a chance before this is all said and done and before the smoke completely clears that we end up having to live with some 8s for maybe a little while. But I feel like over the long term, the sort of stable numbers right around the 7 mark we're at, quite frankly. 6, maybe it touches a little bit, maybe it dabbles into the 8s a little bit. I don't see it getting and staying in a 9 or 10 range. That just doesn't seem sustainable. It doesn't seem to make sense. Conversely, I don't see 5s and 4s coming back anytime soon. I also don't think that's just a viable option for us. There's always exceptions to all this stuff, but it feels like staying at 6.5, 7, 7.5 seems like the right number. It seems like it makes sense. Now, obviously, the $1 million question with every real estate investor is, can I cash flow my properties and how do I react and how do I shift and pivot? And we saw that pivot in the marketplace over the last few years from the transition from a lot of flipping to a lot more holding because of a number of issues impacting and squeezing those profits, longer timelines, supply chain, prices being up too high, prices for materials and for the properties being up too high. And so all those things factored in for everyone to say, that flip is just not providing the kind of margin that I was used to getting or that I'd like to get or that I think I deserve relative to the time I'm putting into it. And so then it becomes a hold environment. Well, holds at 3.5 or 4 is the biggest no-brainer in the world, right? Buy as much as you can. If you got in there and you're lucky, hopefully you don't have to refinance anytime soon. There shouldn't really be a reason to. Pay that mortgage down over time and you are just sitting pretty. Okay, now we talk about 6, 7s, and 8s. So what do? We're careful. We look at a long-term solution and we sort of have to do that math, what that appreciation looks like, what our patience level looks like, what our affordability looks like. I was with someone this morning, we were having breakfast, and we were talking about how some investors will look at a place and say, even if I'm not cash flowing on this property for right now, I'm taking a long-term approach. I'm willing to, for the most part, break even for the initial period of X. Now, that's a different comfort level for different people. But we were talking about this person being comfortable for about 2 years doing that. My equity is still building. This was his rationale. My equity is still building. I'm still investing into this property by paying down the principal. And although I'm not making money, my process, my mindset is in 30 years to be sitting on a beach receiving passive income on fully free and clear properties or just a much larger portfolio with leverage. This will help me accomplish that. So for some people, that's a viable solution and that's a fix. For others, if I can't make money from month 1 on a cash flow basis, I don't think it's worth doing it. So there's a lot of different approaches to that. Those are not questions that necessarily I can answer directly for someone. It's your comfort level, it's your experience, it's your financial situation, and the market you're investing in too. And so there's a lot of different factors in there where we see ourselves as providing the service, the support, the hand-holding, the confidant, the consigliere, as they said in The Godfather, right? To be that advisor, to say, hey, we're a trusted advisor. We want to hold your hand. We want to give you as much feedback and help you talk through and work through the problems and challenges that every investor deals with on a day-to-day basis, whether it's a great market or a mediocre market or any kind of market. We're all in this for the long term. What's my best next move? Should I pivot in this or that direction? And that's really where we find our expertise, is just talking through that.
Yep. Makes sense. And I 3% never made sense to me. I was like, this is free money. It doesn't make sense that it's so low. And so it does make sense. You're saying 6, 7%, that is kind of where you think it should be, quote unquote, where a stabilized interest rate is around 6 to 7%. So you're saying that what we see right now I think we're at 7. I haven't actually looked recently, but
give or take right there. Yeah. Right.
Yeah. What we're seeing right now should be a more long-term, expectation for where interest rates will land. Cap rates are always so closely tied to interest rates because you're never going to be buying a cap rate that's lower than what you're paying on the mortgage.
Right.
So do you see, especially in these coastal markets, cap rates compress so much
Yep.
to where you're buying, large Class A properties at 4 caps, sometimes 3 caps. It's just like
I was going to say, I see
ridiculous.
3 caps. We see 3 caps. Yep.
Yeah.
Yep.
And so with the stabilized interest rate at 6 to 7%, do you see cap rates finally expanding, especially like in the higher tier Class A kind of asset?
I, I don't think right now. I think it's going to be a while. I think just based on the amount of money, the amount of capital that's out there looking to be deployed, I think the people who have pulled money out of the market or would like to pull their money out of the market because of the fluctuations. Having said that, the Nasdaq and the tech sector is back on a tear. If you got in at the recent low, it's been incredibly great over the last, I don't know, 45, 60 days, what have you. But I think there's a lot of money out there chasing any cap rate, quite frankly. Yes, 3.5, but it's like this phenomenal property and it's this great tenant, et cetera. So, you look at it and you're like, does that make sense? I don't think that's done. I'm not sure what inning I would guesstimate that's in, but there seems to be a lot of people still willing to do it. A lot of people still willing to buy those properties. Until that slows down, I don't think that's going to change much because it's working, right? Keep on plugging along. I think, yes, over the long term, it has to change. It should change. But I think we have a little while to go. Is what I would venture to guess until that happens. And it's crazy. It is crazy. But the facts are the facts, right? If you look at what's going on out there, right? We see it and we're like scratching our head, like, how is that happening? Well, it is. So someone feels that makes sense. Now, having said that, I had a call with someone else the other day. We were talking about, there's all this commercial debt coming due, right? And that's sort of a really big story out there.
Yeah.
And you say to yourself, I'm not a brilliant Wall Street guy. I'm not, fancy titles or what have you. But those people did the math and analysis on buying a $50 million portfolio or $50 million development or what have you with 3-year debt at 2.7 or 3% or negative, whatever LIBOR, whatever margin, incredibly low rates, and didn't really do the math or weren't realistic in doing the math for what happens when rates go up and what happens in the long term. It's mind blowing to me. Now, we're conservative and I'm conservative and our businesses run very conservatively and we and manage real estate conservatively too. It's got to really make sense. And we want to look at the worst case scenario and think and do our ROI and do our analysis on a worst case scenario, not a best case scenario. And it's always shocking to me that all the bright minds, they're just looking to deploy capital, quite frankly, I think. But all the bright minds out there are willing to do a lot of this analysis on the best case scenario. Assuming values keep going up and assuming rates stay like this forever, we're all going to make a bloody fortune. But that's never a reality. And so it's always shocking to us when we're sitting on the sidelines being like, how does that happen? How did they end up arriving at that conclusion? And now they're looking in the mirror being like, wait, what happened? Now this property's underwater. We literally have to walk away from it because forget cash flow. It's so underwater. It can't even survive or sustain itself at all anymore. And how did we get here, kind of thing? I'm like, well, I can tell you how you got there. It's not breaking news.
Yeah,
I don't know. Crazy.
Yeah, it's tough, especially when sellers' expectations are still at that for 3, 4, 5% interest rate. And
sellers and buyers haven't met yet, right?
Yeah.
They haven't both come to their senses, I would say, or come to reality, or had the what talk, like, hey, we got to get you on track here. Like, what's going on here? You guys are way off. You're thinking it's a year and a half ago. You're thinking it's a year and a half. You got to arrive in the middle here, and I hope and assume it's just time that makes that happen and that fixes that.
Yeah. So let's shift gears here a little bit and talk a little bit more about your business. You guys do private money lending, hard money lending, bridge lending, all that kind of stuff. When it comes to helping, people purchase commercial real estate or whatever they're trying to do, flips, what is your guys' kind of bread and butter? What are you guys looking for? How do you identify, a good deal versus a bad deal? Take us through your business a little bit.
Absolutely. We see ourselves as sort of a life cycle lender for real estate investing. So we work with a lot of new people and then they evolve into experienced people. We certainly work with tons of experienced people as well. But the new person starting off from scratch, a little intimidated, a little scared, we build and establish that relationship, that comfort level, the education, the knowledge to say, let's get you off the sidelines and let's get you into this, okay? We're going to walk you through it. We're going to take a lot of time starting off on your first. And then we want to be with you for the 10th, for the 20th, for the multi, for the commercial. And we have a division that does the exits as well. So we do the 30-year fixed long-term loans, the DSCR loans, et cetera, to get you out of it if you're following sort of that BRRRR method. And then let's repeat and go back to starting point and do it again. We really take that relationship building and how important that is getting to know the borrower, getting to know and helping to impact their decision-making as they're growing their portfolio. That's really what we think is important to keep safe loans for us and really great service and great attention to safety for our clients as well. Can you make money on this? How much risk are you taking? Is this a good deal overall? Now, in the past few years, every deal was sort of a good deal. It wasn't really that hard, right? But right now, it's a deeper conversation. Does this make sense based on the cash flow and the ROI and interest rates? Are you buying at, again, seller and buyer not agreeing? You're paying the rate or the sale price that this should have been at 2 years ago. That shouldn't be the sale price right now. And that's why it's been sitting. And that's why no one else is buying it. Can we get it a little lower or not? So we're digging deeper and having those conversations. Our claim to fame is understanding that borrower. We dig into each borrower pretty deeply on their finances and understand what they can do. Once you've gotten that part out of the way, they're good with us for the foreseeable future. We'll dabble and re-examine them, but we don't re-underwrite that client every time. So it allows that client to call us up on a Sunday and say, I have 3 more places I want to close the next 2 weeks. And we say, no problem. You're approved with us. Send us the information. Then we evaluate each property. Our other claim to fame on that is eyes on, hands on. We're a local sort of regional lender. We see and visit every property. That's really important for us. We think it's important to look, see, feel, and touch exactly what you're lending on, not trust any third party or any third party other person or appraiser going out there. No slam on appraisers, but we just like to know what we're looking at and where we're putting our money and how we're deploying our capital. And that's been a key to our success, taking extra care of our clients, looking out for our investors at the same time by doing good, safe deals that make sense with good, safe borrowers that make sense, and making sure that borrower, if we can do everything we can to help them, achieve success and a profitable ROI.
Yep. Do you guys focus on a specific asset class, asset type, or is it just across the board?
Yeah, I mean, anything that's, having come from, I was in the traditional mortgage world forever. So having come from the traditional mortgage world, I say anything that's non-owner occupied, right? Anything you're not going to live in is the kind of loan we do. Having said that, our focus is on residential rentals, right?
Okay.
Fix and flip, buy and hold. That's our standard. They might be row homes, townhouses, small condos or apartments or single family homes or a large estate. We also dabble in small multifamily, commercial, mixed use, retail. We do all of it. Right now, we were literally looking at an office and manufacturing headquarters for a pretty nice sized company. This is interesting. The credit crunch is coming a little bit with this situation. Large national bank. They're clearly looking to clear off their books. They called this client in a technical default on their accounts with them. They have a few different loans. You're in a technical default. They're not late. Technical default is they're not meeting some covenant on their finances, their reserves, or whatever. And it wasn't a discussion. It was, we're calling all of the loans you have with us immediately. You better pay us off in 30 days. Great for a hard money guy, right? They come to me and say, hey, I need a loan until I can figure out what I'm going to do here. They're coming to us. Phenomenal LTV, phenomenal equity, phenomenal company. Great fit for us. It's going to be a pretty large building. It's office, it's manufacturing, it's warehousing. There's a lot going on there. It's a large building. And so for us, that's a great opportunity for us to jump in at sort of the 11th hour, and we can move as quickly as possible and fund within days. On a larger property like that, it's going to be a little more than a few days. On your standard residential rental, residential flip, we do those in 1, 2, 3, 4 days, no problem, all day long.
Cool. I love it. I'm a self-storage guy, so maybe I'll have to talk to you about self-storage later.
Great business. Yep.
All right. Well, I just took a peek at the clock. It looks like we have run it down. It's time to jump into the quick question round. Are you ready?
I love it. Let's do it.
Let's do it. It starts with books or any form of education. I need 2 recommendations. Give me 1 for general life wisdom and then 1 for real estate. Before we continue on with today's guest, I want to tell you guys about a community I'm launching on School to help investors like yourself grow your own portfolio. In this community, you'll get access to all the docs I use, all the systems I've built, everything I've used to grow my own portfolio, as well as instructions and guidance on how to get out there and find great deals, how to finance those deals, and then how to manage them for great returns.
Since we're just launching it, the price will be set at a measly $20 per month, and whatever price you join at is the price you'll have for life. We will be increasing the price as the group grows, so if you're at all interested in growing your portfolio along other investors, now is the time to join. I will put the link somewhere in the bio or on our podcast website at therealestateinvestingclub.com, so if you are interested, head on over there. With that said, let's get back to the podcast.
Oh boy. So I was telling someone the other day, and I'm a big fan of Navy SEAL books, and those I use those for discipline, work ethic, hustle. That military mindset. I have a great deal of respect for military and the whole institution and what it teaches about hustle, staying on path, staying focused. I think is extremely important. And that I think has really been the key for me, for my success, from what we're trying to work here at Trias Lending Partners. Just stay the course, stay focused, work hard, keep that discipline. You don't have to be any whiz in any one thing, but the hard work and the grind really get it done. So I would say, you know, those are sort of the types of books that I like to read in that genre, I guess I would say. On general sort of real estate. You know, I've read through a bunch of different books. Recently, I read the Sam Zell book. Sam Zell owned gazillions of commercial properties. Was incredibly successful at selling at the top, and is a pretty brash guy if you listen to some of his stuff. And so it's a great story. He's a great character, and it's just incredible to follow what he did and how he did it. So I would recommend that as a great read.
I've been thinking about picking that up. I
do it.
Own a couple of mobile home parks here in Washington, and I think he started Sun Communities, which is one of the biggest mobile home park companies in the United States. And I've heard he's got a good story, so I've been meaning to pick up his book. I'll have to
love it.
Grab it.
Yep.
All right, moving us on. This is for your younger self. So let's go back to the Josh who was just getting started. Go back to him, look him in the eye, give him one piece of advice moving forward.
Buy more real estate now.
Every single person, if you guys are out there and you haven't, if you're thinking about getting into the game, go back for the last 5 episodes. I asked the same question. Every single person says they wish they got started earlier. So
I just really briefly, I just turned 50. Okay. I was 22 when I graduated college. I think about it. If I had just bought and held where I'd be right now, I'm doing okay. But I mean, how much different things could be?
Yeah,
absolutely. 100%. No brainer.
Yeah, that's been echoed across many episodes. Everybody wishes they got started early. So yeah, if you're out there, get started. Don't wait any longer. Just go buy something. You'll so long that it makes sense. Obviously, get yourself 100%. A good advisor like Josh, who can point you in the right direction. So moving to the next one. This is about your business. Our businesses live and die on the people that work in them. So what are the first 3 positions you hired for, and would you do it differently if you started today?
The first 3 positions we hired for was sort of finance and customer service. So we service all of our loans. We hold all of our loans. So it was bringing on the people in the team to support them, and then finance professionals. So I think the finance professionals are important. You have to understand your numbers and your dollars and cents. That is the most important thing out there. Having said that, for us, and I believe for anyone out there, customer service, relationships. Having people who can service, support, be responsive, be reactive, stay in good touch and good contact. We have very few defaults because we keep in close contact with all of our clients out there. Any problems, any issues, we're aware of it early. We don't have people call and say, I've had an issue for 9 months. My contractor's disappeared. I'm on my 7th person. We're in the loop and we're talking with them and hearing that. And that's because we have great people who keep in good contact. I think that's so important to keep those lines of communication open and understand and appreciate how important communication and service is.
Nice. I love it. All right. Next question is about the United States. It's a big place, a lot of opportunity out there. What is the metro you are most excited about investing in today?
I have to say my backyard. So, we're in the greater sort of Baltimore Mid-Atlantic region. We're 2 hours from Philly. We're an hour from DC. 3 hours from New York, right? So I love where we are. It's affordable. There's a lot of opportunity here, and we are really a DC suburb. DC is incredibly expensive. Great town. Regardless of how you feel about the federal government, it's always growing one way or the other. So there's always growth. There's always more businesses being started there. There's always law firms, et cetera. It all is happening there, and that has trickled out to the suburbs outside of DC and made that great place to invest, great place to do business, but also challenging to be able to afford to live there. So it's pushed out even further, which is pushed out into the further reaches of Virginia and the further areas into Maryland here. And that's where I think there's tremendous opportunity to find places that are still affordable, where the dollars and cents still make sense. Having said that, the Southeast, Southwest, and the whole, I like to say, sort of the smile states, all are no-brainers, and the numbers flesh out that they are all growing by leaps and bounds. So you can't argue against those numbers and that math.
Yep. I actually, I can't remember where I heard this, but I read somewhere that Philly, along with Columbus and one other metro, I can't remember, but they are the top metros in terms of flip volume. So the most flips happen in those cities. I thought that was kind of interesting. All right, moving us on, and this is about finding deals. Every deal or every project that you work on is going to start with finding that deal in the first place. So what's your favorite way to go out there and find good deals?
Extremely hard work. So you have to hustle, and you have to throw and go against anything, anyone, anywhere, anyhow. Don't be humble, be nice, and be a networker, right? Don't be the confident, cocky person who thinks they know everything and thinks they have this trick. Don't look for the one trick or the one solution. It doesn't exist. Be open-minded to network with people who have more experience than you, people who are new, people who have been doing it for 20 years, all the meetup groups online, all the meetup groups in person. Yes, the MLS services online. Yes, wholesalers. Yes, other regular realtors who have pocket deals. If you have a great reputation as being someone open-minded, responsive, receptive, and communicative, you're going to have deals come your way. Put yourself out there, but the hard work is the key. It doesn't take 2 hours on a Sunday. It takes all the time. Most of our clients have full-time jobs. And after that, put the kids to bed, do whatever. They're online or they're attending things in person every night, all the time. That's just a reality for the world we live in, but the results flesh out with incredible success and incredible profit down the road.
Absolutely. Hard work, getting that volume in. When I first got started, I thought I could send out 100 letters and get my first deal done, but that's just not how it works.
Add a few zeros to that, right? Yeah. Right.
All right. Moving us on. This is the second to last question, and this is about mentors. None of us are islands. We all stand on the shoulders of giants. So who is one mentor who has contributed significantly to your career today?
I had to say my father, right? He's no longer here. He passed a few years ago, and I miss him every day. His work ethic, he was a Marine. There goes the military appreciation I have, right? Semper Fi. So he instilled in me an incredible work ethic and an incredible appreciation of clients and relationships and of working with people. And that's really been the key, that hard work and relationship building. I think those are the two strongest things that he instilled in me. I carry that with me every day, and it's been a major cause for my success.
Absolutely. Well, shout out to Josh's dad. Thank you for helping getting him to where he is today. Moves us on to the last question, and this is about your strengths. We're all gifted with strengths that we uniquely give this world. What is your Superman strength?
I think my Superman strength is being able to talk to any and all different types of people and connect and interact with them in I think, a really successful manner, regardless of knowledge, experience, background, income. It doesn't matter. I feel like I've been able to do a really good job, and myself been humble enough to be able to connect and talk to people, whoever you are, wherever you are, however you are, and try to make that connection because it comes from a place of sincerity for me to want to make that connection. And I think I'm good at sharing that and showing that to people, being like, I am who I am. I'm an open book, and I do really care and want to help and want to do some good. I think that's the key. At the end of the day, if you do it the right way and you keep it true and you keep it honest, I don't have to remember what I lied. I don't remember what I did or didn't say, because I know I'm always doing it the right way, and that will always pay off in the long run. I think that's been successful for me.
Absolutely. It's all about relationships, and relationships, they're a reflection of your character. So love that response. And that actually, I lied. That is not the last question. This is the last question.
Keep it going.
Last question. You've given us a lot to think about. I'm sure people want to reach out. What is the best way for people to get in contact with you?
So the easiest, obviously, my email address is josh@triuslending.com, TRIUS lending.com. We are not Truist Bank. I get that from a lot of people. So TRIUSlending.com. Obviously, our website, triuslending.com, LinkedIn, Facebook, Instagram, @triuslending. We're all over social media, YouTube, TikTok. We're doing some stuff now too. So we are everywhere there. I always say happy to help, happy to connect, happy to network. Even if someone's not in our neck of the woods, we do long-term loans everywhere. We're always looking for investors into our funds, which have a phenomenal track record. And really, like I said, always looking to network and connect with anyone from anywhere, anyhow. Just happy to help, happy to be a resource.
All right. TriusLending.com. I will put that in the show notes. So if you guys want to reach out, just click a little more in the description. It'll pull down the full description, and in there you can find Josh's URL. All right, man. That wraps it up. Thank you very much for hopping on the show.
Great stuff. Really appreciate it. And good seeing you. And hope things keep going well out on the West Coast there.
All right. For everybody who's here with us today, thank you guys for showing up. You are the reason we do this. So if you guys have any questions whatsoever, reach out to me, Gabe at therealestateinvestingclub.com. And if you guys want to support the show, all we ask is you give us a like, subscribe, share, all that jazz. Other than that, hope you guys have a great week. Keep rocking real estate, and I look forward to seeing you on the next episode. All right, before I officially sign off, I have a quick announcement to make. If you're interested in becoming a passive investor in one of my deals, my own company, Kaizen Properties, is looking for capital partners for our upcoming projects. We invest in what are known as recession-resistant assets, mainly self-storage facilities, mobile home and RV parks, and industrial properties. If you're interested in investing and would like to learn a little bit more about my company, our investing criteria, and some of the previous projects we've done, go to the Real Estate Investing Club podcast at therealestateinvestingclub.com and scroll all the way down to the bottom of the page. Click on the Invest With Us button. That'll pop up the investor form. Fill that out, and we will reach back out to you as soon as we can. Or if you prefer a little bit more of a personal touch, you can reach out to me at Gabe at therealestateinvestingclub.com. So really, that is it. Again, it was a pleasure hanging out with you guys during this episode, and I look forward to seeing you on the next episode.